Okay, so let's see. We'll get this going. I'm Ryan Kurlinski, Manager in the Department of Market Monitoring, and here to go over some key highlights from our recently posted Q2 2024 report on market issues and performance. So this report is the product of I think it's about 17 people in the Department of Market Monitoring. I'm just the person who gets to present it. We'll get this started here. I will try to end on time. We'll see how this goes today, though. Apologize in advance, this seems a little rushed. So this graph shows gas prices, monthly average gas prices at Henry Hub, which serves as a national reference point for natural gas in the country, and as well as the gas prices at major hubs across the West. The main story from this is that in the second quarter of 2024, while the Henry Hub gas prices down only 3% relative to the same quarter of 2023, gas prices at the other the major hubs across the West were down significantly, around 50% or more for each of the major hubs in the West. And so gas prices going down, as we've been seeing for many years now, brought electricity prices in the West down with them. So this is showing in the yellow and green lines the peak day-ahead product bilateral prices at the two major bilateral trading hubs in the West, Mid-Columbia and Palo Verde, as well as average monthly day-ahead prices at two major load nodes in the CAISO balancing area for those same peak hours, Pacific Gas and Electric and Southern California Edison in the dotted lines. So the main takeaway here that the average bilateral prices at Mid-C and Palo Verde were down more than 40% in the second quarter of 2024 relative to Q2 2023. And so were the average day-ahead prices at the major CAISO load nodes. Those are also down about 40%. We see trends in the last 8 months or so of Mid-C having higher prices than Palo Verde and the average CAISO prices. That continued into April and May of 2024, but for June we see the Palo Verde prices creeping back up and being about the same as the Mid-C prices. This graph is showing the average 15-minute market prices by component for all balancing areas in the WEIM for the second quarter of 2024. The line here shows the overall average prices for each balancing area. Load-weighted average prices across the WEIM are also down about 40% in the second quarter of 2024 compared to second quarter of 2023. This graph, and this shows here the line here showing the overall average prices, showing lower prices in areas in the South. So Desert Southwest, Southern California, those balancing areas and areas had on average lower prices than areas in the Pacific Northwest, Intermountain West, and Northern California. This graph breaks this down by a component of LMP. So look at the yellow bars here. That's the impact on price separation from congestion on transmission within the CAISO balancing area. And so we see that those flows and that congestion was from south to north. The congestion on those internal CAISO constraints were contributing to lower prices in Southern California, Desert Southwest, relative to Pacific Northwest areas, and Intermountain West and Northern California. The GHG component here, that's the GHG component of prices, also played a significant role here in terms of price separation. That's due to the GHG cost on electricity consumed in California that contributed to having prices elevated in California balancing areas relative to balancing areas outside of California. This graph is a heat map. It shows the hourly average LMPs for each of the 24 hours in a day for every balancing area in the WEIM. The heat map shows it relative to the SMEC, the System Marginal Energy Component. That's a reference price. We have that for each hour. The brighter orange for each hour indicates prices that are relatively higher than the system marginal energy component. Darker blue indicates prices that are lower than the SMEC. So what we're seeing here is that price separation for lower prices in the south, higher prices in the north, mainly driven by congestion from south to north in the middle of the day during the solar hours in the middle of the day. During the non-solar hours, the dominant pattern we hear are prices that are, we see the dark blue, right, in all areas besides the California balancing areas. So prices were lower and outside California than they were inside California, and that was mainly driven by the greenhouse gas cost for power consumed in California. This graph shows the transmission ratepayer losses from the congestion revenue rights auction. The green bars here shows the payments to auctioned CRRs from the price difference between CRR nodes in the day-ahead market. The blue bar shows the auction revenues received by ratepayers, and the transmission ratepayer losses from auctioned CRRs were about $14 million in the second quarter of 2024, up from $1 million in the second quarter of 2023. I do want to note, it is worth, one of these days we'll have more time to discuss this. I do want to emphasize that DMM has been recommending, we put out a white paper actually just recently with analysis on an alternative auction design, which would eliminate these losses for transmission ratepayers. And what we've been recommending is to not, I want to be clear that DMM is not recommending to get rid of congestion revenue rights, right? Congestion revenue rights are allocated to load serving entities, right? So these are the entities who pay for transmission, or for transmission ratepayers who pay for the transmission to be built. DMM thinks it's reasonable to allocate congestion revenue rights, right, to the entities who pay for the transmission. And also DMM thinks it's reasonable to have an auction to allow people to sell back their allocated CRRs, or for anyone else to offer to sell CRRs. Our concern is just one element of the auction, the current auction design, which essentially forces transmission ratepayers to offer to sell a large quantity of congestion revenue rights at a $0 reservation price. So most of these losses we've seen for transmission ratepayers has been from that one element of the auction design. So we put out a white paper recently going over an alternative auction design, which we think would get rid of these losses. Here we're looking at the real-time and balance offsets for balancing, for the WIM balancing areas that only participate in the real-time market, so not the day-ahead market. Obviously, currently, the only balancing area that participates in the day market is the CAISO, so this is all the real-time and balance offsets for all other balancing areas. The next slide, I just want to point out there's a significant difference in the drivers of these real-time and balance offsets for areas that are only in the real-time versus the CAISO and the day-ahead. So here we're seeing for the second quarter of 2024, the real-time balance offsets for these WIM areas were a $33 million credit to these entities. And most of that we can see here is the green, is the congestion component of the imbalance offset. So for WEIM areas, right, that are not participating in the day ahead, they have, most of this congestion rate comes from congestion rate on WEIM transfer constraints, right? So transfer constraints, so areas have base transfers between each other going into WEIM, but then they have a higher limit on those transfer constraints in the WEIM. And so when additional power flows in WEIM between areas, you'll end up getting congestion rent on those constraints, which ends up being an allocated credit to the WEIM areas. Now, that's a very different dynamic from the real-time and balance offsets for areas participating in the day-ahead market. So it's just showing those offsets, and we see here that the real-time balance offsets for the CAISO balancing area in the day-ahead market, those were a cost of $59 million in the second quarter of 2024. The most of that is coming from, actually more than all of it is coming from the congestion component. The green bars here, we're seeing the congestion portion of the real-time balance offsets were $62 million. And that's the reason that's such a different dynamic there is that for in the day ahead market, entities the transmission lines have a certain limit, and so entities are essentially buying flows over constraints in the day ahead market. But then in the real-time market, oftentimes due to loop flows, unmodeled loop flows, operators have to reduce the limits of the lines in real time down below what those flows were in the day ahead market, which then forces the market to buy back that reduction in limits at the real-time shadow price of the constraint. So this ends up being a cost and uplift that has to be allocated to load and exports. This graph shows the determinants of the residual unit commitment market procurement. It's showing the procurement that's incremental to the schedules that came out of the IFM. The overall gray line shows the incremental procurement. The colored bars show the components that's broken down into. The main focus that we've been looking at these last 4 or 5 quarters here, I'm going to focus on these the red bars. Those are the adjustments to the residual unit commitment load forecast that operators will the CAISO balancing area will make these adjustments to the load forecast to account for uncertainty that may materialize between the day-ahead market forecast and the forecast that materialize in the real time in the 15-minute market. What we see for Q2 of 2024, those the red bars are down significantly from what we saw for the third quarter and fourth quarter of 2023, last half of 2023, and also down significantly April, May, and June from the first quarter of 2024. But it is actually up significantly, up about 104% from those uncertainty adjustments from the second quarter of 2023. It's up 47% from those uncertainty adjustments for the second quarter of 2022. The driver behind this is what behind these kind of significant changes is that the ISO in July 2023 started using the Mosaic quantile regression method to try to estimate the uncertainty between the day-ahead and real-time markets that they wanted the operator adjustments and certain adjustments to try to cover. And so we see the red bars going up in July 2023. The Mosaic quantile regression method started being used. Then they made significant adjustments to that method in Q1 2024. So we see it go down January, February, March of 2024. And they made further adjustments in May of 2024. We'll talk about the next slide. So the adjustments that were made, so prior to December 21st, 2023, the ISO was using the Mosaic quantile regression to try to estimate the 97.5th percentile of uncertainty. So they were trying to figure out the amount of capacity. That's sort of the red bars here. Trying to figure out the amount of capacity that if the ISO procured that extra amount, it would be a 97.5% chance that the capacity they procured would cover all net load uncertainty that might materialize between the day ahead and real time market. The change they made on December 21st was to, instead of trying to cover uncertainty 97.5% of the time each hour, to instead use outside system conditions, such as how tight are conditions in the West or how tight are conditions in CAISO, to set the capacity requirement to only try to cover uncertainty 75% of the time. That's the yellow bars, or 50% of the time. That's the green bars. And then May 7th, ISO made further adjustments to that, where they would only do these upward uncertainty adjustments during peak morning and evening hours. Hourly 7 to 9, and I believe 19 to 21. They can also set even during those hours, the ISO could choose to set those upward uncertainty adjustments to 0 or to only the 25th percentile. So we're seeing starting May 7th, and even going back to December 21st, but especially because it's clear here in the second quarter in May 7th that during most hours of most days, the ISO and operators didn't value having any extra capacity to cover uncertainty. That was not something that they felt was needed to for the reliability of the markets. And so again, I think the key takeaway here is that the ISO has started using outside conditions, other conditions to figure out what percentile of uncertainty should be covered. And it's only under some circumstances when they want to cover, when they want to use adjustments to cover the 97.5th percentile of uncertainty. Let's see, there is an important link between this and the imbalance reserve up product demand curve, which is a key part of the EDAM, right? That the imbalance reserve up product is intended to cover basically the same kind of uncertainty between day and real time that these upward RUC adjustments is meant to cover. And that is currently designed to try to cover uncertainty to value at least $25 per megawatt hour, the last megawatt of capacity to cover the 97.5th percentile of uncertainty. So think of it as the imbalance reserve up demand curve is currently designed to be kind of like these red bars you see in December 2023. But the ISO has shown that that during most hours there's not any demand for anywhere near that level of extra capacity. So the DMO continues to recommend, and I think we'll write this up more in the Q3 report. The DMO continues to recommend that the ISO work with stakeholders to incorporate these other system conditions into the design of the imbalance reserve up demand curve to shift that demand curve back so that it's not overvaluing capacity and going for 97.5% of uncertainty all the time, but only when it's needed. With there, let me stop for some questions. That was very fast, but Mike, can we take any questions? You guys still hear me? Let's see. Mike, can people still hear me? Put in the
Yes, we can
chat
still
if you
hear you.
can. Okay. Hey, Emma, do you want to see if anyone has any questions?
Yes, sure. There are no questions in the chat.
Okay. Okay. And people, please feel free to raise your hand too, because I can't really see the chat in my setup. But I did see a message pop up as a work question, so thank you for the person who put that in there. All right, I'll keep rolling then. Oh, go.
If you would like to ask a question by raising your hand, you can indicate that you wish to ask a question by navigating to the bottom right corner of the participant panel and raising your hand. All right, we have no raised hands right now.
Okay. See, I will skip this point for now. This is just a point we have in our report, which we've been writing about for a while, but which we haven't highlighted in a meeting yet, but I'll save that for a different quarterly report. Okay, so let's get to the new material in our last, we got about 12 minutes here. A new material that Pat Prendergast and Adam Swally put together on the ISO's implementation of its new design and policy for determining the amount of capacity available for reservations for priority wheels through the CAISO balancing area, where these high priority wheels receive the same prioritization in the optimization as native CAISO load. Let's see. We will focus here on Malin, how this new implementation worked in detail for Malin. It's one of the two interties that entities made requests for reservations of these high priority wheels on. And so the implementation, so the first reservation window for the new implementation was for reservations that started in June. And the initial reservation window started off in January. And so I want to note here, so what we're seeing here in this graph, these are different capacity elements that went into the CAISO balancing area's determination of how much capacity to make available for priority wheel through reservations on the Malin intertie. These are final values though. So for instance, looking at, for June, these are final values. The preliminary values for November and December, I do want to focus just on June here for the sake of time. And that's important because most of what I'm going to talk about has to do with the difference between what the capacities values are earlier in the process, the initial reservation window in January, versus what the capacity values ended up, the final capacity values ended up being right before June or during June. So in order for the CAISO bouncer to determine how much capacity to make available for priority wheel-through reservations, they start off looking at the total transmission capacity over the Malin intertie. They subtract off expected transmission outages. And again, I'm talking about it from the January perspective when they're first trying to figure out how much to make available. And they also subtract off existing transmission constraints, ETCs and TORs. And that's how you get this essentially the red line here, available capacity. And they also need to consider the native load needs over the Malin intertie. That is determined as the RA imports plus the RA imports at Malin plus the imports that were non-RA, but that for which load serving entities had contracts for some of that, plus a little and the max, the sum of those, you know, and the higher of the, you know, taking that value for previous 2 years, 2022 and 2023, and then adding on a little bit for a potential load growth from the previous 2 years. So that's the green bar here, native load needs. And then the CAISO will also consider this yellow bar, the transmission reliability margin, which is meant to account for uncertainty that there may be in native load needs and in transmission outages. When the ISO makes determination in the various reservation windows, say in January, there's uncertainty over what the native load needs are actually going to end up being in January for June. And there's also uncertainty what those transmission outages are going to be. So we would expect, right, this red line we see for June to be above the green bar, the native load needs, and the amount of priority wheel through reserved. But again, that it may not be all the time because of uncertainty materializing in the native load needs and in the transmission outages. So in January of 2024 for June, you know, when the CAISO determined the available capacity and then subtracted off the native load needs and the transmission reliability margin, they determined there was 248 megawatts left over that could potentially be used for high priority wheel-through reservations. The aqua bar here is the amount of priority wheel-through reservations were actually made by market participants and ended up only being 72 megawatts out of the 248 made available. And that was fortunate because, as we'll see in the next couple slides, the ISO had underestimated the native load needs, and there were also transmission, and much more significantly, there were transmission outages that materialized that the CAISO had not taken into consideration in January when making 248 megawatts of Malin transmission capacity available for priority wheel-throughs. So this graph on the left here shows the CAISO's estimate of the native load needs in January. And it was 1,087 megawatts, made up of mainly RA imports, some yellow here load growth, and then some historic non-RA imports, which there were contracts for. But then on the right here, the green is the final shown value of RA imports 30 days before June at Malin, and that was 1,192 megawatts, which was 105 megawatts more than the estimate from January. And so it just makes the point here that, you know, underestimating native load needs in an earlier reservation window that can result in the CAISO bouncing area making more transmission capacity available for priority wheel-throughs than the intertie might be able to support if all priority wheel-throughs and import RA scheduled over the intertie at the same time. This graph shows the daily, so it's the same capacity values as we saw two slides ago, but it shows the daily capacity values. And so it helps to focus here on June 19th to 26th, looking at the available transmission there. That's about, my understanding is that's about the available transmission that the CAISO thought was available back in the January reservation window. So we see there that, you know, with the green native load needs, and then the aqua and gray, that adds up to the amount to 248 megawatts that the CAISO had made available for potential priority wheel-through reservations. And on top of that's the transmission reserve margin. So on these kind of days, these kind of days that they predicted would be the situation in June, back in January, right? There was enough capacity, right, to make 248 megawatts of Malin capacity available for transmission wheel-throughs. But then that's shipped over to the first few days of June, and what the ISO had not anticipated an additional outage that reduced the available transmission capacity on the Malin intertie for the first half of June. So we can see there for most of these days in the first half of June that if that aqua bar had been, instead of 72 megawatts, if it had been 248 megawatts that ISO had made available, that the CAISO would have oversubscribed the Malin capacity, and it would not have been able to handle all of the import RA and priority wheel-throughs if priority wheels had used up all the reservations made available. And again, it's because of the transmission outage, extra transmission outage, which was not anticipated back in the earlier window. Take a look here at the usage of these reservations. So the reservations, the priority wheel reservations, they're for block of days and then block of hours within those days that the entity has a power contract for. So we see here Malin in June, their reservation was ended up being for all 7 days of the week, but for the block of hour 7 to 22. So we see the blue bars here showing they had the reservations of 72 megawatts for those whatever that is, 16 hours in a day. And the green bar shows the average usage, where usage of the reservations when they self-schedule right, the high priority wheel, so that they get the same priority as native load. To see the average usage of these entities over the month of June for these hours was about 7 megawatts, much less than the 72 megawatts they reserved for. But then I think it's interesting here to jump to a particular hour. And so this is showing hour ending 19, the same usage, but it's the same picture, right? Same IFM schedules and priority wheel-through awards, but it's showing hour ending 19 for each of the 30 days. So we see here that the entities with these reservations, they weren't scheduling a small amount, right? A small amount each day. Instead, they use these reservations to schedule all 72 megawatts of the award, but on only 3 of the 30 days that they had the reservations for. The report, you also go into detail on the knob intertie, which had a major outage after in the January window, market participants had reserved 378 megawatts of priority wheel reservations when the ISO had not anticipated an outage on the knob intertie, which ended up reducing available capacity down to 0. But again, I think the knob is a really interesting case because it shows the difficulty in a balancing area, CAISO or others, anticipating in advance how much transmission capacity can they sell to outside entities. It's extremely difficult to anticipate transmission outages. So we see here that there was actually extra capacity available for every day in June over knob, except the 2 days when knob had the unanticipated outage, which took its capacity down to 0, and obviously resulted in the knob being oversubscribed for both resource adequacy imports and priority wheel-through reservations. Okay, so that was way faster than I thought I would do it. I hope I covered things in a way that some people can understand. I thank you all for your patience here. People have stuck around throughout the almost 30 minutes of technical difficulties there. Please, I want to invite everyone to reach out to DMM if you have any questions about this or other things. We have tons of extra material on our website, other quarterly reports, stakeholder comments, regulatory filings. So feel free to shoot me or others in DMM any questions you may have, and we'd be happy to chat with you. With that, Ahmed, do we have any questions from anybody in the last minute or so here?
Well, as a reminder, feel free to write your question out in the chat and select panelists from the drop-down menu. If you would like to indicate that you wish to ask a verbal question, you can dial *3 if you are calling in, or you can navigate to the bottom right of the participant panel and raise your hand to indicate that you wish to ask a question. All right. Does not seem like we have any questions.
Okay. All right. Well, thank you, everybody, and happy Thanksgiving. Look forward to speaking to everyone again when we get to when the Q3 report comes out. Thanks again, everyone. Bye.
This event has concluded. Thank you for using Event Services. You may now disconnect.